Welcome back. We're diving right into an analysis called 3 Reasons Broadcom Will Crush Earnings in 2026. It lays out a really high conviction bull case, focusing on the AI supercycle, custom silicon, and the huge margin power from the VMware deal.
Okay, yeah, I agree. The structure is immediately compelling. It's sharp, data-driven, and you get the thesis right away. Custom silicon for growth, VMware for margins. It's a great setup.
It is.
But for a title that strong, that they're going to crush earnings, we have to make sure the foundation is, completely bomb-proof.
That seems like the perfect place to start. The whole thing leans so heavily on this confidence, right? That $45 billion in AI revenue, the VMware margin expansion.
Exactly. And for an analysis like this to really work, you have to start by building a robust defense. You have to neutralize the bear case before it gets a chance to take root.
And that's the missing piece here. The tone is just relentlessly optimistic. It's all about the upside. But it doesn't really, formally tackle the risks that a skeptical investor is going to bring up immediately.
Right. A high-conviction analysis has to proactively integrate and neutralize potential counterarguments. That's what proves the thesis is durable.
So the weakness is that this consistently bullish tone leaves it open to, survivorship bias? It's like you're only looking at the timeline where everything goes perfectly.
Precisely. So the opportunity isn't just to add a risk section at the end. It's to weave that risk mitigation right into the core arguments.
Turn the potential weaknesses into strengths.
Exactly. Structure the bull points to directly confront those vulnerabilities. Show you've thought through the objections and you've overcome them.
Okay, so let's get concrete. Reason number 1 is this explosion in custom silicon. It correctly points out this huge reliance on CapEx from, Google, Meta, OpenAI.
Which is a strength, but it's also a huge red flag for customer concentration. That's the first thing a bear will say.
So you have to address that head on.
You have to. What is the contingency plan? What happens if Google slows down spending? Or if Meta decides, hey, we're going to try to bring more of this design in-house? You have to show why that's unlikely.
And how would you do that?
You emphasize the moat. It's not just about selling them a chip. It's about Broadcom's ability to integrate that custom silicon with their best-in-class networking fabric, like the Tomahawk 6. It's an architecture they can't just replicate overnight. That's the lock-in.
Okay, that deepens the argument quite a bit. Now, what about VMware? That's central to reason number 2. The analysis just says the painful integration is over.
And it's a bit too neat. We need to go beyond that and acknowledge the execution risk is still there. This pivot to a subscription model is great for margins, but it's not happening in a vacuum.
Right, you've got competitors fighting back.
You do. So is there a risk of churn? Or what about pricing pressure? Hawkton's whole strategy is about efficiency, but you have to show that it's not just about cost cutting.
Yeah, what are the structural safeguards that make sure those margins are stable? How do we know they won't get compressed in the first, say, 18 months?
That's the tension you have to explore. For instance, you could show that the cost cutting during the acquisition was so deep that even if churn hits the high end of expectations, the margin floor is still way above what old VMware could do.
So you're stress testing the model in the analysis itself.
Yes. And that brings us to the valuation. The analysis notes the forward PE is around 28 times for 26 estimates.
Which isn't exactly cheap. That implies a lot of growth is already baked in.
100%. So you have to acknowledge that. You say, look, the market is already pricing in some growth. Then you challenge it. You demonstrate how those bear risks, the customer concentration, the integration, are actually overstated compared to the potential reward. That's how you turn it from a bullish report into a real, durable investment thesis.
That discussion on the PE is a perfect transition, actually. If the valuation already assumes high growth, the analysis has to prove that the upside is, materially higher than what everyone else is expecting.
Right. The title says, Broadcom will crush earnings. That's a strong claim.
So that moves us to our second point. You have to define the delta between the market consensus and this differentiated view.
Exactly. To justify a title that strong, the analysis must clearly define that gap.
And the weakness I see right now is that it throws out these big, bullish numbers, like that $45 billion in AI revenue, but it doesn't quite articulate why that leads to a massive earnings surprise instead of just meeting high expectations.
Yeah, the beat isn't quantified. The strength is sort of embedded in the data, but you need to pull it out and show the reader, here is the number Wall Street is missing.
So the opportunity is to frame each of the 3 reasons as a place where the market is under-modeling Broadcom's potential.
Yes. Quantify that delta, show how it all adds up to something bigger than the sum of its parts and bigger than what current assumptions allow for.
Okay, let's use an example. Reason number 3, the forgotten recovery. That seems like the perfect place to find a surprise factor.
It's the perfect sleeper catalyst.
This is the part of Broadcom everyone dismisses, the non-AI legacy stuff. Broadband, enterprise switching. Most analysts are modeling that as flat, maybe even down a little in 26.
And this analysis is forecasting a return to low single-digit growth.
Yes, but it needs to go further. It should explicitly contrast that forecast with the prevailing sentiment. Say, most bearish models assume this legacy business stays flat. We project 3% growth.
And then you show the math.
You explain how that seemingly minor recovery, when you combine it with the high-margin VMware revenue and multiply it by Broadcom's scale, triggers a massive earnings surprise that literally isn't in anyone else's model.
So you're translating a small, overlooked detail into a big financial impact.
Precisely. And you can do the same thing with the software margins from Reason 2. It's not enough to just say they're higher. You have to define what the market is currently pricing in for Broadcom's blended gross margin.
Okay, so let's say consensus is at, 68% for FY26?
Right. The analysis needs to demonstrate how the full-year impact of that subscription model pushes the actual gross margin to, say, 71%.
And that 300 basis point difference?
That 3 percentage point beat is the quantifiable proof of the crush. You make that gap visible, because that kind of margin expansion drops straight to the bottom line and accelerates everything.
I see how quantifying that delta really adds the conviction. But, the analysis also promises a double beat in the summary, which implies this powerful interplay between the factors. Right now, they kind of read like a list.
That's the final structural opportunity. They're 3 great points, but they feel isolated.
We need to deepen the narrative interplay among the 3 catalysts.
Yes. The analysis should narratively connect them to show how they reinforced each other, creating a powerful multiplicative effect on free cash flow.
So the weakness is that they're presented in isolation. Hardware growth, software margin, legacy stability. It feels additive, not
multiplicative. The better way to do it is to explicitly link them. Link the high-growth hardware from custom silicon to the high-margin software from VMware. Show how Broadcom is capturing value at multiple high-profit points at the same time.
Okay, that's really actionable. Give me a concrete example of how you'd weave that narrative in.
All right, think about the customer spending cycle. You show how the massive CapEx from Google or Meta for custom silicon, that's reason 1, immediately requires Broadcom's high-margin Ethernet switching, the Tomahawk 6 networking component. You need both.
Right.
But then you take it a step further. That high-performance physical infrastructure often runs on the highly profitable VMware software stack, reason 2, for all the virtualization and cloud management.
So wait, the VMware software isn't just some separate business. It's a required, high-profit layer needed to actually run the hardware they're also selling.
Exactly. It's a triple dip. They get you on the chip, the network that connects the chips, and the software that manages the whole thing.
That's a much more powerful story.
And you can reverse the logic too for more depth. Emphasize how the stable, predictable cash flow from the VMware cash machine allows the company to aggressively fund the R&D for the next generation of AI chips. It ensures reason 1 keeps accelerating.
So it's a flywheel, a self-funding, high-margin growth engine that's insulated from short-term bumps.
That's the framing. It guarantees the durability of the whole crush thesis. And the analysis already has a great concluding line. Growth from custom silicon, margins from VMware, and stability from the dividend.
So you just need to use that as a structural anchor throughout the whole piece.
Exactly. Make every section feed back into that continuous self-strengthening cycle.
This has been a really focused critique of what's already a powerful bull case. So, to summarize the actionable steps, we see 3 big opportunities. First, strengthen the argument by mitigating the bear case. Actually address the risks like customer concentration and the VMware pivot.
Second, define that delta. Quantify the gap between your conviction and the market consensus. Use the legacy recovery and the blended gross margins to show exactly where the crush comes from. Give us the numbers Wall Street is missing.
And third, deepen that narrative interplay. Don't just list 3 reasons. Show how the custom silicon, the networking moat, and VMware create a synergistic loop that maximizes cash flow at every part of the AI stack.
Right. Incorporating those structural elements will make the argument just so much more robust and resilient to skepticism.